Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Powell spikes the punch bowl. So back in the 1950s, Fed Chair William McChesney Martin gave a speech likening the Fed to the chaperone at the party whose job it is to take away the punch bowl right when the party is really warming up. Now, the Fed may have been a little late in its task in taking away that punch bowl this time, as inflation has moved beyond anyone's idea of acceptable. Nevertheless, the bowl's been gone all year this year, and investors have been dealing with a nasty hangover. Yesterday, Fed Chair Jerome Powell gave a speech that indicated the Fed would likely slow the pace of its future interest rate hikes, and the market celebrated like it was 1999. It didn't matter, everyone already assumed the pace of increases would slow. The door Powell opened to less restrictive monetary policy resulted in a gain of more than 3% for the S&P 500, and the growth-oriented Nasdaq index was up more than 4%. Bonds and commodities joined the party as well. So the rise in asset values since the beginning of October will certainly come as welcome news to weary investors, but they should be careful not to get too carried away. While more gains are certainly possible in the near term, the trend in earnings revisions heading into 2023 is still decidedly negative. Caution is warranted until the business fundamentals send a clearer signal that the tide has turned. For this week's featured insight, take advantage of tax loss selling. Well, obviously no one likes to lose money, but you might as well turn your investment losses into a positive tax benefit. Selling investments at a loss can be deducted against your income up to a total of $3,000. They can also be used to offset an unlimited amount of capital gains, and any unused losses can be carried forward indefinitely into future tax years, offsetting both income and future gains. Now, while you can't sell a stock for a loss and buy the same stock right back, you'd have to wait at least 31 days to do that. You can purchase a similar company immediately and still have exposure to potential market upside. For example, you could sell your Coca-Cola stock at a loss and immediately purchase Pepsi. The loss will have been harvested for tax purposes, and you'd still have the benefit of owning one of the world's largest producers of snacks and soft drinks. Looking ahead, Santa rally? Well, in my last Investor's Edge, I mentioned the possibility of some holiday cheer in the markets and the tendency for November and December to be two of the strongest months on average for stocks. Now we know that November did not disappoint. Investors had plenty to be thankful for last month. So now it's on to December. Now, although there are still plenty of risks on the horizon, December has the potential to reward investors as well, given that a lot of capital gets allocated toward the end of the year, while it's the last chance for portfolio managers to juice their numbers. This year could be especially strong in that sense, as investor sentiment has been quite pessimistic and portfolio positioning has been extremely defensive. So after the November rally, a lot of investors could be worried about missing out and jump on the market bandwagon. Many of people have heard of the Santa Claus rally, and that tends to occur toward the end of the year. So we'll just have to wait and see if Santa's coming to town this year. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.